So, hi everyone, it's me, your Manu Issue, and welcome back to my channel Manu Issue ACCA classes. In today's video, we are going to deal with a long question of F7 from the consolidated statement of financial position and PL account. So, I think we have done a few questions in the previous video. So, in this video, we will be going to do question number 415 of Pandar. So without wasting our time, let's start the question. And one more thing, if you are watching my video for the first time, please like and subscribe to my channel and share it among your friends. It's really motivate me. Or please, if you have any doubt, query, just ask me in the comment sections. I will definitely reply to your I will try to solve your query and whatever doubt you are having. So let's move to the question. The question is for question number 415. Okay. So we will leave the few space and we will do walking here over the side. Okay. So first we will write down additional information. Okay. And let's read out the requirement of the question. Okay. The question is having two requirements. The first one is to calculate the carrying amount of the investment in Umbra to be included within the consolidated statement of financial position as at 30 September 20X9. And second one is for the prepare the consolidated statement of profit or loss for the Pandar Group for the year ended 30 September 20X9. Okay, fine. So it means we have to prepare a PL consolidated PL account, and as well as we need to calculate the carrying amount of investment in the associates. Okay, so here we have to just note down the additional information so that we can easily put the figure on the format. Okay, so let's read out the question. On 1st April 20X9, Pandar purchased 80% of equity shares in Salva. It means Pandar is the parent company. Pandar. Pandar is parent company who purchased 80% of ordinary share capital of Salva, and it means NCI is 20%. Okay. So, and date of acquisition is on 1st April 20X9. And what is the year end? Year end is 30 September 20X9. So time of acquisition, I will write in the shortcut TOA, which stands for times of acquisition. So time of acquisition is April, May, June, July, August, September. It means 6 months. Okay. Okay, so it means the question is for the major acquisition, right? So we have to just take each and every figure of PL of subsidiary only for the 6 months. So TPC we won't require in the case of PL. So now on the same date, Pandar acquired 40% of 40 million equity share in Umbra by paying 2 per share. Okay, again Pandar acquired 40% of Umbra. It means Umbra is subsidiary. Okay, and same date as above, like on 4th April 20X9, and year in 30 September 20X9. So time of acquisition is 6 months. Here TPC has been given. TPC is equal to 40 million. I mean, out of 40 million, 40% share have been acquired. 40% into 40 million. So we will take it 30 as common. It means 40,000. Okay, and cost per share has been given, that is 2. Okay, so 32,000 is the total purchase consideration. Okay, so now the statement of the profit or loss for the year ended 30 September 20x9 are given. For the parent, for subsidiary, and for associate, the P&L account has been given. Okay, so let's read out the additional information which is given below. The first, okay, so here we will write down first. The fair value of net assets of Salva at the date of acquisition were equal to their carrying amount with the exception of an item of plant which had a carrying amount of 12 million and a fair value of 17 million. It means fair value adjustment of plant. Its value has been now 17 million. We will take 3 common 17,000. But it's we have recorded its value on its carrying amount of 12 million, which means 12,000. So it means 5,000 is excess, which means we have to record. So it means journal entry is debit PPE. We will just add this amount on the property, plant and equipment. So amount 5,000. And we will also add it on the net asset both at acquisition and reporting date while we calculate the working too. So credit net assets of subsidiary. So 5,000. So if the value has been increasing, there might be the post acquisition depreciation as well. So post acquisition depreciation is equal to, we will take 5,000, and remaining life item given in the question is, so this plant had a remaining life of 5 years with straight line depreciation at the date of acquisition Salva. All depreciation is charged to cost of sales. Even the question don't indicate where we should charge it depreciation, we will always assume it should be charged on the cost of sales. In sometimes it might be different. Question might state to charge the depreciation in the administrative expense or anything else. Just be careful at this point. So remaining life is 5. So it's depreciation is for the 1 year, as we have already seen that it's a mid-year acquisition case. So we will just multiply it by 6 by 12. So 500. So journal entry is same as above. We will now deduct this amount from the PPE and as well as from the net asset of subsidiary. So debit net asset of sub at the reporting date only, not from the acquisition date, and credit PPE. So 500. So next point. Okay, the fair value of plant has not been reflected in the Salva financial statement. No fair value additions were required on the acquisition of investment in the Ambra. So there is no any adjustment in case of the associates. Okay. So question additional information point 2. Immediately after its acquisition Salva, the Pandar invested 50 million in an 8% loan note from Salva. It means Pandar invested in Salva. Loan amount is 50 million. We will take 30 common, so it means 50,000, and finance is this multiply by 8% into 6 divided by 12. No, just wait. Yeah. We will do 6 by 12 because 8% is for the whole year. Okay. Now this done. So next point is what? All interest accruing to 30 September 20x1 has been accounted by the both entities. Salva also had other loans issuing at 30 September 20x9. So here in this case, the Pandar is investing in the loan of Salva It means the interest which will be paid by Salva to Pandar. Pandar will record it as a investment income, is a interest income. So we need to remove this transaction, and as well as we need to remove it from the Salva because Salva is paying the interest. So in both cases, the one is recording as a income, other is recording as expense. So we need to remove this. Okay. So point third. Point third is dividend paid by Salva. So dividend is 8,000. So parent portion is this into parent percentage of share, that is 80% has been acquired. So 6,400 is parent one. So 4 number point. After the acquisition, Pandar sold goods to Salva. Okay, Pandar sold to Salva. Okay, Pandar sold to Salva. Selling price equal to 15 million, that is 15,000. Okay, and gross profit of 20%. It means margin. So 20%. Salva had 1/3 of this goods still remain in the inventory. If the all good has been sold by the year ends, there is no need to calculate a POP. So, but here the some goods have been remaining in the inventory, so we need to calculate a POP. So 15,000 into 20% into 1 divided by 3. So POP amount is 1,000. Again, Pandar sold goods to associates. Okay, so selling price is okay. So Pandar sold goods to Amra for 6 million, still 6,000, and making a same margin, that is as above, that is 20%. So POP equal to what is the is there any good remaining in the inventory? Yes, Amra had half of these goods still in the inventory at 30 September 20x9. So it means into this we will do 50%. Okay, and parent portion of POP is, in case of associate, we need to find out the parent portion of the POP. So we will simply take the percentage of the parent share investment in the associate, that is the 40%, and multiply it by the POP we have calculated. So 240. Okay. So next point is 5 number. The non-controlling interest in Salva is its value at its full fair value at the date of acquisition. It means NCI is calculated using the fair value. Okay, fair value method. We don't need this, but if we are preparing the consolidated statement of financial position, in that case we require this value. So next is the goodwill of Salva has been impaired by the 2 million. Okay, so goodwill impairment 2 million means 2,000 and impairment in associate investment also given in the question, and due to the lost value of Pandar investment in the Amra is the associate, has been impaired by the 3 million at 30 September 20x9. So 3,000. Okay. So next point is all items in the above statement of profit or loss are deemed to be accrue evenly over the year unless otherwise indicated. Obviously, we will assume this if sometimes question might say the from this to this month the profit has been this. I don't think so. This kind of scenario will be given in the question. So simply. In each and every question, you will find this line that all items in the above statement of profit or loss are deemed to be accrue evenly over the year unless otherwise indicated. So let's move to the calculation which is required by the question. Okay, the first one is carrying amount of investment in the associates, right? So first we will write down cost of investment, initial investment, which we calculated earlier. Okay. Here you can see we have done 32,000, right? Okay. So now we will add profit after tax of associates, profit, or in case of profit, we'll write down profit. If there is loss, then in that case loss after tax. Okay. So here we can see this information in the PL of associates, that is the 5,000 loss. Okay. So parent percentage is 40% into 5,000, 2,000. Okay. Then after that we will deduct less impairment. Okay. Okay. So impairment, it is always given the question. Just don't apportion just like we used to do in case of the subsidiary, the parent portion of goodwill impairment and NCI portion of goodwill impairment. We don't have to do this in case of the associates. Okay, in associates it is clearly indicated in the question, the parent impairment of the investment in associates is this amount. Simply just put this amount. Nothing else we have to do. Okay. Then we will deduct POP. If parent sold to subsidiary, is there POP any parent is holding to subsidiary? Okay, we just forgot to apportion this 6/12 as it is mid-year acquisition. So now carrying amount of investment equal to sum. Okay, so answer is 27760 is the carrying amount of investment. Now we will prepare consolidated profit or loss. Okay, so first we will take revenue. Here I will show you the how I calculate the value of revenue. Just wait. Okay, so we will take the parent full revenue. We want apportion it into the 6/12. So we will take the full amount, and then we will add subsidiary 150,000. Okay, into 6 divided by 12. Okay, because it's mid-year acquisition case. Then we will deduct the intra-group transaction. Here we can look in the additional point. Parent sold to subsidiary some goods. Yeah, the selling price is 15,000. So we will deduct this from the revenue. So here we will 15,000. So I will make an indication so that you won't get confused. Intra group sales. Okay. So now just calculate 211234 plus 15,000, no, 150,000 into 6 divided by 12 minus, okay, then we will deduct less cost of sales. Cost of sales, again we will take the full amount of parent, and then subsidiary, it's mid-year acquisition case, we will just took the full amount and multiply it by 6 divided by 12, and again we will subtract the intra-group sales. I will write in the shortcut IGS, intra-group sales, and here we will add a POP amount which we have calculated. POP amount is 1,000, right? 1,000 POP. One more thing we need to add is here is post acquisition depreciation, which we have calculated in the first point of additional information, that is a 500. Okay, so just don't forget this. I will write in the bracket post acquisition depreciation in shortcut. Okay, so 126,123 plus 100,000, 6 divided by 12 minus 15,000 plus 1,000 plus 500. Okay. We will subtract this, so I will keep it in the bracket. Now gross profit. This, okay, gross profit is 107,500. So now what is the distribution cost? Okay, so less distribution cost. We will do the same. 11,200 we will take the full amount of parent, and for the subsidiary we will just portion it into 6 divided by 12. 11,200 plus 7,000 into 6 divided by 12. Okay, so now is administrative expense. So we will take full amount of parent, 18,300. For the subsidiary, we will take 9,000 into 6 divided by 12. Okay, and we will add here one more thing, goodwill impairment in subsidiary, which is given in the question. We have noted down in the last point, I think it was, yes, 2,000. We will deduct this amount from here, administrative expense. So goodwill 2,000 bracket goodwill impairment. Okay, so 18,300 plus 9,000 into 6 divided by 12, then plus 2,000. Okay, so now investment income here, 9,500. Okay, so 9,500 for the parents, it includes both interest as well as dividend. So here subsidiary has given a dividend during the year, so we will just eliminate the parent portion of the dividend which we have calculated earlier, that is 6,400. And one more thing we need to remove is interest. interest income, which we have calculated earlier, 2000. Just wait, I will show you. 9500 minus here is the interest income which parent have been included, received from the subsidiary. So we need to eliminate this again. Dividend here 6400 which we have calculated, this also needs to be removed. So 1100 is investment income. Okay, then after finance cost. Finance cost, I told earlier, if one is giving the interest, it's expense for the one company and income for the other company. So we need to remove this amount from the both sides, as we have removed the interest income from the parent one. So still we need to remove it from the finance cost of the subsidiary. Okay. So what is the finance cost of the parent? 1800 plus 3000 minus 2000 interest income which have been paid by subsidiary to parent, and then we will take 6 divided by 12. So 1800 and 1000 is 6 divided by 12. So 2300 is finance cost. After that, we will include PAT of associates. Okay. So there has been loss in the associates. We can see 5000, and time of acquisition is 6 months. So we will take 6 divided only 6 by 12 value of 5000, and the parent percentage of acquisition, that is the 40,000. So 5000 into 6 divided by 12 into 40%. Okay, then we will take here impairment. Impairment, we have, it has been given in the question, that is 3000. Okay, and next thing we need to remove is POP of the associates. Okay, so we have already calculated the parent portion of the POP. 240. So 240 is so now so what I will do for this, you might get confused what I did. So okay, so it's for the parent portion of the associates. Let it be. Okay, so profit before tax equal to then one more thing we have to remove is tax. So tax expenses for 15,000 for the parent, and we will again take 10,000 into 6 by 12 of subsidiary. So 20,000, right? So profit for the year equal to this 42560. Now we need to calculate the attributable attributable to MCI. Okay, so we will just here you might have a little bit confusion. So as profit for the year of subsidiary is 21,000. Okay, so this profit include the interest paid by subsidiary to parent, which we need to add back. So here I will do a small working. Okay, so subsidiary post acquisition profit amount is 90. Just wait, 21,000. It's 21,000 is for the whole year. So I will simply write profit after tax 21,000. We will add back the finance cost, the subsidiary finance cost, the subsidiary paid to parents, that is 2,000. Okay, so total amount is this plus this 23,000. Then we will take pre-acquisition profit this into 6 divided by 12. 11,500 is pre-acquisition. So post-acquisition equal to 21,000 minus this 9,500. Okay. So you just need to figure out the when the loan has been. When the parent invested in the loan of subsidiary, it's on the date of acquisition. So we will just add back the finance cost because it has been deducted to arrive at the profit for the year. So we will add back those amounts. Then we will apportion it on the basis of the pre-acquisition period and post-acquisition period. So pre-acquisition period is for the 6 months because it has been 6 months. So both as pre and post acquisition period is for the 6 months. So we will just take out the pre-acquisition profit by just multiplying this amount by 6 divided by 12. So we will get 11,500, and we will deduct this amount from the 21,000. So we will get 9,500, the post acquisition profit. Okay. Then we will subtract few things. The first one is post acquisition depreciation, that is the 500, and then goodwill impairment. Okay, and the amount was 2,000. So what is the now revised profit? So this plus this plus this 7,000. Okay. So NCI equal to 7,000 into 20%. So 1,400 is for the NCI. So here we will write down 1,400 is for NCI. So parent equity holder equal to, we will just subtract this from this. So 1,160 is for the parent holder. Okay. Okay. So in this video we will do only this question. In next video I will continue the remaining questions. Okay. So bye bye. Good night. Good night. Sorry. Take care. And please share my channel among your friends and subscribe to my channel. Tell them to subscribe to my channel and hit the bell icon so that you can get the notifications when I will upload the video. Okay, so bye, take care.